Twitter and make some money while doing that. With us to talk about all of this, Scott Martin, Chief Market Strategist at United Advisors, Lance Roberts, CEO and Chief Economist at Street Talk Advisors, and Fox Business Correspondent Jeff Flock. Thank you all for joining us. Jeff, let me start with you. What are they doing? How can you look at all these tweets and have enough time to figure out the direction of the market?
What they do, Adam, it's called stock market analytics. I spent the day at the company today. What they do is they make a dictionary of keywords and phrases that are either positive or negative. Then they look at all the 400 million tweets a day. They filter out the guys that don't know anything. They just look at the tweets from the financial professionals and key people. When they hit one of these positive or negative phrases, they assign a value to it. And then they can look and see, is this stock trending positive or is it trending negative? In the Twitterverse, it often leads, it's in advance of a move positive or negative in the stock. And it's a great program.
And I heard in one of your reports, they actually have 2,000 clients that they sell this to, the professional clients, hedge funds, at $5,000 a pop a month. Is that accurate?
Yeah, do the math on that. They've got 2,000 clients, so, you know, you do the math, that's a lot of dough. I said, why don't you just use this information for yourself? He goes, we can make more money selling it.
Okay, so I'm going to take a shot at that, but I'm going to let Lance Roberts take a shot at that first. Lance, I got to tell you, it sounds like a good idea, but at the end of the day, most hedge funds, the clients of this, fail to perform at a rate that's comparable to the S&P 500. Last year, return at hedge funds was, what was it, 6%? The S&P was 13.4%. Right. Year to date, some of the biggest funds, I did a little research, Greenlight Capital, 5.78%, Paulson Advantage Plus, 3.4%, Pershing Square, 4.6%. Sounds like another gimmick, this idea that, you know, you could, the tweeting analysis. What do you think?
Well, I think we need to actually take a step backwards from all of this. You know, the average investor, the people watching your show right now, they're not sitting at home with high-frequency trading algorithms and computers that are sitting on the floor of the New York Stock Exchange or right next door to it and analyzing this data in milliseconds. You know, we need to kind of think about actually reviewing how our markets actually work. You know, over the last few years, the flash crashes that we've had, a lot of the volatility in the markets are driven by the fact that, you know, the bulk of the trading that happens now is run by computers, by algorithmic trading, by high-frequency trading. And I'm not so sure that in the markets that we have today that that's really a fair place for investors in general. And I think this is why you're seeing so many individual investors kind of give up and walk away because they just can't win at the game.
Scott, you know, he raises a very good point. We have seen retail investors. You just look at the volume in stocks, and you can see retail investors are really not there to the tune or to the level that the high-frequency trading crowd is there. How do you respond to that?
No, I think he's absolutely right. In fact, I feel like Lance read my notes, because that's the thing, Adam, is that I just, you know, that he's right, though. I mean, if you're sitting at home, you know, the individual investor at home that's trying to pick off pennies in, say, Amazon or Apple, you're in the wrong game, because by the time you hit the number, the button to say make that trade, thousands of computers have made that trade. Now, the moral of the story, though, is just like the hash crash and then the flash crash years before, it was a blip. You know, if you look at the flash crash in 2010, the market was up after the next couple weeks. So the individual investor, if you're playing at home, I would just say ignore this stuff. Hey, it's fun to watch it, but don't get caught up in it.
Jeff, I want to ask you a quick question, because I think it's great that people can make money. I think what those gentlemen have done with this formula, fine, they can have at it. But how does that play into true investing? What they're doing seems to me like a casino, as opposed to I'm going to invest in a company and I'm going to see what happens. They're in and out, and they're selling this to people who are in and out and have no real, they're not investing, they're gaming.
Well, yeah, I don't know if I'd call it gaming. I think it's got to be a piece of the pie, you know, I mean, a piece of the puzzle in terms of how you make your investment decisions. If you do, in fact, trade with more rapidity, maybe something like this helps you. It also helps you more, perhaps, instead of making money but not losing money, which, as you guys know, one bad trade can sometimes screw your whole, you know, your whole day up.
As
what
Mr.
it does
Paulson,
is it kind of tips you off. Well, it tips you off to a bad stock that there's a lot of negative talk about, and you say, well, gee, do I want to hedge that position, or do I want to sell the stock early?
Lance, would you follow this kind of, it seems like, you know, medieval, you know, voodoo to me, especially since if I were a really smart guy, I would come up with an algorithm that would launch Twitter tweets that would then influence that algorithm so that people would do what I want so that I could then make money off of it. I mean, couldn't you do that?
Well, yeah, well, look, that's the whole thing. It's like, you know, this is the fool's game, and whatever you come out with, somebody's going to come out with something that's going to take advantage of it. But let's go back to what the question really was here, is can individual investors invest and make money? And individual investors, remember, the average American, they're savers. They're not investors. And they're not in this game to pick off a few pennies here or there. If I'm buying a stock because I believe in the company and the fundamentals are strong, what do I care whether the stock misses earnings by a penny or makes earnings by a penny if I'm investing in the stock for a long-term investment and I'm buying value? None of this matters to me. But what does matter, and here's where it's important, we have margin debt now back at record levels, back to where we were in 2007. The problem comes in when something like the flash crash occurs that starts triggering margin calls, and then you cause a collapse in the market that happens so quickly that individuals can't react to hedge off or to sell or to get out of the market. That's what we saw happen in 2008, and we've got exactly the same scenario set up now. All we need is the catalyst.
Scott, are you worried that they call it a black swan event, but some unforeseen event is going to trigger some kind of massive sell-off? The computers would react so fast that nobody would be able to make heads or tails before we drop precipitously in the market?
That's potentially true, and it probably is due to happen, right? It seems like that stuff happens every few years. But Adam, I got to disagree kind of with Lance, though. Again, going back to 2010, guys, that flash crash, the market was up over the next couple weeks. It was up over the next couple of quarters. In fact, that was one of the start of the biggest bull run we've had, right, in the last 3 or 4 years. So I don't know, Adam. I think people should not worry about that stuff. I just hope if that does happen, we have cash on the sidelines to use to start going in and buying.
Yes, because if you have cash on the sidelines, it's earning no interest thanks to the Federal Reserve. And on that, I get the last word and the fat word. How's that? All three of you, thank you for joining us. We're going to be watching this. We'll tweet about it. How's that? Up next, you don't